Happy Friday morning. 30 minutes until the start of the last trading session of the week. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming out, the Santa rally still in the cards as Goldman and Citadel Securities join bulls in predicting more gains.
Nike's turnaround loses traction with the stock headed for its fourth consecutive annual decline.
And TikTok's long-awaited break from China is finally underway. Its U.S. data is now under domestic control.
Matt, one of the stocks I'm looking at this morning is Oracle. The ups and downs of this company have been really remarkable. Today, in the pre-market, it is up 4.5%. Concerns about spending be damned, because this time around, they're leading a group of U.S. investors that are overseeing TikTok's U.S. business. The company is valued around $14 billion. So maybe we don't like your debt unless you're doing it to buy TikTok? I don't know.
Yeah, volatility is the key here. I see what you did with the traction thing and Nike at the top.
I wish I could take credit for it, but it's the brilliance of our producers.
Nike warned that sales will decline this quarter amid weakness in China, and with its Converse brand as well. You can see that shareholders are really taking it out on the Oregon-based shoemaker, down 11.4% in the pre-market. And Deborah Weinswig of Coresight Research joined Bloomberg shortly after the results came out on the close.
I've always looked at C-suite changes as an indication of where things are going. Nike cannot hang on to their innovation talent. I mean, it is like a revolving door like I've never seen, to be quite honest, in any company in my entire career. And so I do worry, honestly, from kind of like my essence, that there is something still off at Nike.
Some harsh words. For more on Nike, Romaine Bostick, co-host of The Close, joins us now, who was covering those earnings when they came out. Romaine, the first sense when they came out was like, hey, this isn't too bad. And then things changed.
Yeah, I mean, this is kind of a tale of two cities. In North America, things are going well. They're selling more apparel, selling more sneakers. But there's a lot of concerns right now about the China business, which has been in decline even before Elliott Hill got there. This quarter was no different, a 17% drop. And he addressed this on the conference call. I don't know if we can put up one of the quotes here, because he talked about this idea that China, they kind of fell into this sort of lifestyle trap. And he talked about how it's much more of a mono-brand culture over there, and you're competing much more on price. Basically, they had no pricing power, and they had a lot of competition from other brands. The other component of this isn't just what's going on with China, but it's also about Nike's direct sales to consumers. So if you go to Nike.com or something like that, apparently you're not going to Nike.com, because that was also negative as well. So they've got a lot to do here. He's only about a little more than a year right now into this turnaround strategy. And while the last couple of quarters, you saw some progress, it looks like this particular quarter, maybe just a little bit of a stall.
You know, Deborah Weinswig, your interview with her yesterday, she said they're losing their innovators, right?
Yeah.
But you can do so much on their website, and
yeah.
I don't really see that at the competitors. This market is worried about on cloud and what are the ones that Katie wears? Hokas.
Hokas, yeah. They're the big chunky ones, and Nike's got into the big chunky ones too. But they announced yesterday several new products that are coming online in January. They expanded the Nike Skims a collaboration that they have with Kim Kardashian. They have something called Nike Mind, which has got much more athletics-focused type of a sort of a prehab type of wear. That's debuting in January. They have this whole Win Now program. So there is a pipeline of, I guess, what would be called innovative products. But to Deborah's point, the problem is this pipeline should have existed long before today. There was a clear gap that they had in that pipeline of innovation. This is something that Elliott Hill has been trying to get back.
All right, Romaine, thanks very much. Romaine Bostick there on Nike. You can catch his program starting at 3 o'clock this afternoon, The Close, with Katie Greifeld. Now, TikTok is being bought by a group of buyers led by Oracle, with both parties signing a U.S. joint venture. Bloomberg Tech's Caroline Hyde, I should say, joins us now, and this is just one of a slew of the stories that you guys are going to be covering at 11 o'clock. But a huge one for Oracle, right? And for, I guess, the kids.
And the kids. And me. I love a bit of TikTok.
That's true.
But
yeah.
A lot of the slew of the stories we're going to be covering in Bloomberg Tech involve Oracle in some way, shape, or form. It's just becoming omnipresent across so many stories. Now, what's interesting as to why Oracle's rallying today. Now, you might bear in mind that Coreweave and other key cloud, neo-cloud players are on the upside today. So there seems to be, after the Micron numbers, a little bit of release of that AI anxiety. But Oracle's up because a lot of the analysts out there say this is a win to own a strategic asset. Remember, TikTok is a big part of their current cloud partnership. The cloud that Oracle has got into and is seen as a winning formula, a lot of that is predicated on TikTok as a big client. So TikTok's not going anywhere. And in fact, they're going to potentially be taking a 15% stake. Sure, that's going to cost them a couple of billion, and that's probably just a drop in the bucket of the $100 billion of debt that they already have on their balance sheet and the overall capex spend that they're going to be committing. But the idea that they're going to be able to ramp up, that maybe this is a growth opportunity for them, they're going to have ownership. The question is, there are still so many question marks. Look, we understand from previous reporting by Bloomberg and the White House announcement of this deal earlier a few months ago that, well, 50% of the profits made by this new US TikTok is actually still going to go to ByteDance. What role is ByteDance still going to have? What oversight are they going to have? Is this going to be signed off by China's regulators? Is this going to be signed off by US Congress as well?
Part of the, I don't know, hilarity, I'm not sure what it is, the head-scratchingness, irony, sure, whatever, is just looking at something like Oracle and all these AI names that you mentioned is the kind of oscillating back and forth between, like, the world is over to, like, yeah, we're so back. Part of that also is OpenAI and these huge valuations they can still command. The Wall Street Journal reporting $830 billion. What, it was just $500 billion in the fall? What does that huge ramp-up imply for OpenAI?
That it wants to be bigger than SpaceX. You kind of end up thinking, is this just to try and be the world's most valuable market capitalization in a private company? Well,
they are growing also at a massive pace in terms of users, right?
Look, this is it. They've got almost 1 billion monthly users. They have seen a revenue increase rate that we have never seen before. Sure, it is tiny in comparison to the $200 billion that they're going to be spending up to 2030, but we are seeing just growth that we've never seen, touched, felt before. This is why VCs are so willing to back them. Look, they're likely to have to go pretty international if they're going to be raising up to $100 billion. That's what Wall Street Journal is currently talking about. They've already tapped SoftBank to a significant amount of money. They've already got Middle Eastern investors. MGX, which is also going to be buying a bit of TikTok, has also been interested and been buying in OpenAI as well. Where else are they going to get the funding? But we keep proving out time and time again there is a wall of desire to get into private assets right now. There's 16 trillion already going into them. Think of SpaceX, think of Databricks this week. OpenAI, with its growth rate, no wonder people are bandying around numbers like 850 billion. And maybe that's why Oracle, of course, needs to keep on building out its data centers.
Well, Caroline, I'm very much so looking forward to the Oracle show starting at 11 a.m.
Come join in.
Bloomberg Tech's Caroline Hyde, of course, the show is Bloomberg Tech, which you should stick around for. We also got FedEx earnings out after the close yesterday. The stock is down 3.7%, despite upgrading its full-year targets. A string of cost headwinds is weighing on FedEx. For more, Lee Klaskow, senior logistics analyst for Bloomberg Intelligence, joins us. Lee, what were the dark spots for these earnings in FedEx?
Yeah, so their second quarter earnings was actually pretty, I would say, better than expected, but the outlook is a little more clouded, and that is really because of a lot of headwinds that they're facing, whether it's from higher variable comp, incentive comp, or if that's due to the grounding of their MD-11 fleet. Also, they are facing a weaker LTL or less than truckload market, which FedEx Freight, that's their segment that operates in that industry, and they're the largest player in that industry. So those three are the kind of the major headwinds that the company is facing in their second half. But what I would note is that their restructuring plans seem to be going well. Their implementation of their peak plan and the execution of those plans appear to be going well as well. I think that some of these headwinds are short term, especially when you think of the MD-11 headwind. But the freight, their FedEx Freight business is going to face probably weak demand, probably in the first half of the calendar year next year.
Lee, just for those people who aren't very familiar with this story, when you say MD-11, you're talking about McDonnell Douglas, and I can't believe that it's still around. What is FedEx going to do? I mean, do they have to buy a whole new fleet of planes, and why were they using this one for so long?
I mean, they're slowly transitioning away from the MD-11s to more efficient planes. That's just part of their fleet overhaul that they've been doing, and UPS has been doing similar things. Some of people might remember there was a tragic accident of a UPS MD-11 plane. The whole fleet was grounded. Expectations are the inspections will continue, and they'll probably be back in the air by sometime next year. But this is their busy season, and to go out and lease in at least a short-term lease a plane is pretty expensive, and that's kind of what's driving some of these headwinds. And they also might use trucking for some of these volumes, at least domestically, when it makes sense, and that also could add to the cost as well.
All right, Lee Klaskow there talking to us about FedEx earnings and the old McDonnell Douglas. The last time they made one of those was in the year 2000, so it's been 25 years. Quick check on what's going on in the markets on this Friday. After yesterday, we finally had gains at the close, and we're looking right now also at gains in futures, but they are slight. So 0.1% on the S&P and 0.25% on the NASDAQ.
Let's look at some of the individual movers, because this broke in just a few hours ago. AbbVie, Bristol Myers, Merck, and other drug makers, they are expected on Friday afternoon, which is today, that they would announce agreements with the U.S. to lower certain drug prices. That is, according to a Reuters report. Shares are as high as 1/3% for AbbVie moving this morning. Yeah, that broke in our editorial meeting, which I know because Joe, who manages the headlines, instantly sent them. I wasn't there because I might have been on TV.
You were on Bloomberg surveillance this morning. KB Home earnings disappointed with profit missing estimates, and its outlook also seen as we can see the shares down 6% in the pre-market.
Now let's look at Coinbase, because they are currently suing Michigan, Illinois, Connecticut over their attempts to regulate prediction markets. It says the states cannot interfere with CFTC jurisdiction over the sector. Shares higher by 2.4%.
Coming up, GM's Sterling Anderson is emerging as a top candidate to succeed CEO Mary Barra at the biggest U.S. car maker. More on that next. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. U.S. Trade Representative Jamieson Greer tells Bloomberg the decision to allow exports of Nvidia's H200 chips to China is a standalone matter within the broader U.S.-China trading relationship. He also weighed in on the tariffs case that's before, right now, the Supreme Court.
President Trump, the administration, has essentially reset the global trading order to move from total liberal trade into the United States without any cost to a new, fair, and balanced approach. It would be terrible if the Supreme Court overturned the case, because we have built a new global trading order on the back of these tariffs. We will do whatever we need to do to make sure that we can maintain the tariffs we need.
The Trump administration has suspended the green card lottery program, which it says allowed the suspect in the Brown University and MIT shootings to come to the U.S. According to Homeland Security Secretary Kristi Noem, the pause is intended to, quote, ensure no more Americans are harmed by this disastrous program. And Ken Griffin's Citadel is on track for its worst annual return since 2018 after wagers on natural gas faltered. Sources tell Bloomberg the flagship fund gained 9.3% through December 18th. This could be the sixth year since Citadel's inception that returned less than 10%, underscoring how much it's depended on commodities trading to supercharge returns in recent years. Citadel Securities is still crushing it. And Bloomberg's weekend big take is also trending. It looks at how John Paulson is getting a gold mine through the revival of antimony mining. The Pentagon pushing to develop domestic supply of the critical mineral after China banned its exports to the U.S. Gold is often found alongside antimony, and the push for domestic antimony production could be a bonanza for John Paulson's Perpetua Resources, which owns an antimony mine. You can read more on this story on the Bloomberg terminal on Bloomberg.com, and I'm sure if you want to know, you can Google antimony, because you've probably never heard of it.
I've never heard that word be said so many times in a row. Never in my life.
Today was honestly the first time I'd ever heard of that critical mineral, and I don't know if it's actually pronounced antimony.
I was going to say, I don't know how to pronounce it, but now I'm going to be thinking about antimony all weekend. Hey, Matt, another big story, which is highly read today. General Motors is eyeing a recent hire as a potential successor to CEO Mary Barra. Chief Product Officer Sterling Anderson is emerging as a top candidate, partially due to his experience in innovation with Tesla. Bloomberg's David Welch broke the news and joins us from Detroit. David, what is the interest as him as a successor to Barra suggest about the direction of GM going forward?
What it says is the company's really looking at software and how it changes a vehicle. Tesla and the Chinese automakers do a lot with software controlling not just infotainment and that sort of thing, but actual mechanical aspects of the vehicle, braking, the suspension and feel and how vehicles drive, steering, all of that stuff. And you're going to see more of that coming into vehicles. So you need someone who understands how to marry up software code and semiconductors and computer controls with the old school hardware that's been mechanically running vehicles for over 100 years. They brought in some software people from Apple who get software, but Sterling Anderson is the kind of guy, having been at not only at Tesla, but at Aurora Innovation, a self-driving trucking company, who understands how to marry them up. So that's one of the reasons they brought him in to run product development. And that's the sort of talent they want for future leadership of General Motors. A lot needs to happen before he gets the top job. First of all, Mary Barra needs to leave, but he also needs to succeed in this role. But he's the kind of leader they're building up and grooming for something bigger in years down the line.
David, I've been asking myself lately, and a lot of people have been asking me, why it looks like GM is doing so much better with EVs than Ford. You know, the Ford Motor Company took a almost $20 billion charge to pivot away from its EV business and only really had two offerings out there, right? The F-150 Lightning and the Mustang Mach-E, whereas Chevy has the Blazer, the Equinox, the Silverado, the Bolt, GMC has the Hummer and the Sierra, Cadillac has the Lyriq, the Escalade IQ, the Vistic, the Optiq, the Celestiq. Like, they have a ton, and they're losing far less money. How's that working out?
Well, look, first off, the GM took a $1.6 billion charge, and we're going to see another one. They've already told us in the fourth quarter that I think is going to be bigger. So we'll have to really compare the losses, we'll have to tally up how much General Motors writes down in the fourth quarter. But that Ford number was very big. I think in GM's case, they spent more time developing a battery pack and a platform that could host a variety of vehicles. And it is a lower cost way to do it. Now, they're losing money on their electric vehicle program as well. They've had to close down some plants, get out of some joint ventures, cut back production. So I think they're also having a tough time of it. Everybody is right now, but maybe not as tough a time because they've got more offerings to get higher volume. They've got this platform that gives you better scale. And they've changed that. Like, they're changing how their battery pack, they're changing the chemistry they're going to use. They're changing what shape of cells they're going to use in order to drive costs down. And they've been working at really getting closer to profitability for a long time. I think Ford just doesn't have scale because they basically had two vehicles that were made sort of as one-offs, and that's a very expensive way to do it.
Yeah, I met Sterling Anderson for the first time with you here in New York at the reveal of the Cadillac Escalade IQ, or actually really the technology that they're using in that vehicle. But they don't seem like they're going to pivot away from EVs, right? I mean, whereas I guess Ford isn't totally dropping that business, General Motors seems really to remain committed. Is that the right read?
I think it is. I mean, they're having to pull back because of where the market is, right? I mean, they have a dozen vehicles for sale with their different brands, and they've got 3 assembly plants that can make them. And they've got 2 battery plants going and potentially a 3rd in Indiana. The building is up, but they're not making batteries there yet. But they are pushing on new battery chemistries. Lithium manganese rich batteries they think is going to be a breakthrough for them, where it'll drive up driving range above what lithium iron phosphate, which is what the Chinese like to use, and still be low cost. So they're looking at ways to make this profitable and get to scale, even though the market's not really buying right now, and they're hoping to drive that by just making the vehicles better and cheaper down the line.
All right, David, thanks so much for joining us. David Welch is our, well, maybe the foremost expert on General Motors. He wrote the book on Mary Barra, literally, and it's called Charging Ahead, fittingly. Coming up, Crossmark's Victoria Fernandez says there is real concern for a market pullback despite the sentiment around the Santa rally. This is Bloomberg Open Interest.
Goldman, alongside Citadel Securities, have joined the chorus of bullish notes heading into the new year. Goldman trader Gail Hafif told clients, quote, barring any major shocks, it will be hard to fight the overwhelmingly positive seasonal period we are entering. While we don't necessarily see a dramatic rally, we do think there is room to go up from here into the year end. Joining us now is Crossmark Chief Market Strategist Victoria Fernandez. Victoria, I'd love to know what you are telling clients as we head into 2026. Is it time to start readjusting portfolios or to stay as is and ride out what maybe will be a rally into the end of the year?
Yeah, I do think hopefully that most people, and what we've done for our clients is we've already made those adjustments. So we trimmed back on some of those tech names that had those really high valuations that were going up consistently, trimmed those and found other parts of the market to invest in: financials, industrials, materials. Those are the areas where we've been adding in our portfolio. So hopefully people have already done that. If so, then I think you do ride through this through the end of the year. You're well positioned. You're ready to see what happens going into the first quarter of next year, which I do think there's a lot of tailwinds for the first quarter, first half of next year. And you want to be in the market to take advantage of those. But then I think you have to start being a little more defensive, having some defense in your portfolio as things maybe start to unwind a little bit around the middle of next year.
All right, Victoria, we're going to keep you with us. We got the opening bell coming up on this Friday after a positive finish to the trade yesterday. Victoria Fernandez will join us on the other side of that for a more in-depth look at what she expects for 2026. There's an interesting question of whether or not lower income households, especially in a weakening labor market, are going to pull back too much. Or if the higher end, with its wealth effect in a strengthening stock market, will continue to support earnings. Check on futures ahead of the bell. We're looking at some slight gains today, 0.1% on the S&P, a little more than 1/3% on the NASDAQ, as today the AI story looks great because of TikTok. This is Bloomberg. We are moments away from the start of trading on this Friday. This is Bloomberg Open Interest. I'm Matt Miller. We had a steady drop over 4 sessions on the indexes. We turned that around yesterday, closing up about 0.8% on the S&P, and now we're up another 0.25% on futures. So NASDAQ futures doing even better, looks to be a positive end to the week. You hear the opening bell and see it here on the New York Stock Exchange. Being rung by a group of people, I guess, playing a basketball tournament this weekend at the Barclays Center. The best college women's basketball players, at least 4 of those teams, including the Huskies, are going to get together and battle it out. You can see that on Fox. Okio Pharma ring the opening bell down at the NASDAQ. They've had a decent year to date. It's been tough if you're with them longer term, but they're an ophthalmology biopharmaceutical company, and I'm hoping they can come up with a cure for presbyopia, which you luckily don't know what it is yet.
And I don't want to know what it is, and I hope I never have to know what it is.
It's no bueno.
Sounds horrible. Sounds very no bueno. On the bueno side of things, Oracle shares, they are up 5.4% this morning. I should say all of the AI hurting trades are up today. Nebius is up, Coreweave is up. So it might partially be that. It also might partially be that TikTok says that ByteDance and consortium of investors led by Oracle signed an agreement to bring the social platform's U.S. business into domestic control, Matt.
So it's happening, and shareholders are happy about that.
Has China approved it? We don't fully know it's happening.
I mean, something is happening, and it's better than just dragging on forever. Nike warned that the thing investors want to be happening is not. Sales are declining this quarter amid continued weakness in China and with its Converse brand. They just can't seem to turn it around, and as a result, the shares are getting decimated now, down almost exactly 10%. Let's bring back Crossmark Chief Market Strategist Victoria Fernandez. And I mean, this could be, an example, Victoria, of a company where they really need consumers to go out there and spend. I wonder if a weaker labor market, and real problems for the lower quintiles economically are going to hurt their ability to spend, and then that hurts corporate earnings, corporate margins, or are, the wealthier people who are living off of these gains and asset classes going to be, doing enough to offset that drop? What's your take?
Yeah, Matt, I think both of those elements are going to be happening simultaneously. So you're right. You look at a lower income consumer, their spending is driven by compensation. And when we look at the latest non-farm payrolls, when we look at some of the other private data that we have, we see that wages are beginning to stagnate. People are not quitting their jobs as frequently as they were before. It tells us that wages are going to start to stagnate a little bit where they are, which means you're going to have a slower consumer on the lower income side. But then you do look at a higher income consumer. That's not driven by compensation. Their spending is driven by the wealth effect. Stock market's doing better. Housing prices, the value of their homes, those are the things that really drive a higher income consumer. And they feel pretty confident right now and continue to spend. You see it in the holiday spending numbers. Lower income consumers, negative versus last year. Higher income consumers, positive. So there's definitely a divergence between the two. We're going to have to see what wins out. But right now, it seems like the higher income consumer is able to buffer some of the negative effects that we're seeing. The problem is, how long does that last?
What would undo that, Victoria? What would make that type of environment unsustainable?
I think it really comes down to earnings. So the stock market obviously is being driven by earnings. We look at expectations for fourth quarter and they continue to move higher on earnings growth and on revenue growth. You're up to 13-14% EPS growth expectations for next year. So, you're getting multiple years of double-digit earnings growth. If that holds true, then I think you have a higher income consumer that feels good and they'll continue to spend. But, we've been talking about the tech sector and the dominance that they've had in this market. They're still expected to be 47% of earnings growth next year. So it really comes down to what those companies are doing. Can they generate the cash flow? Can they generate the return on investment that people need to see in order for those earnings to be strong? If so, then I think you have a good support under the economy.
What is your take on the debt picture of a lot of these companies borrowing so much to fuel CapEx? I'm talking about obviously the AI companies or the big Mag 7 companies. Is it a concern at all, especially since a lot of it's being done off balance sheet, or is it too minuscule compared to their market caps?
I mean, I know it's not a huge portion of their market caps, but it's still something you want to pay attention to. I don't think anyone is concerned if, with Microsoft coming to the market or Alphabet coming to the market, that they're not going to be able to pay their interest or their principal on their debt. What I do think is concerning, though, is when you have like Oracle, you saw all of a sudden their spreads widen dramatically on existing debt that was out there. And so you have to start being concerned. What do those credit default swaps look like? You're seeing those start to worsen on some of these names. So you have to watch it, because the credit market a lot of times is where you can see the financial stress really start. So that's kind of your canary in the coal mine. We'll be watching it very closely to give us an idea of how concerned the market really is.
And you've seen that divergence start to play out, Victoria. Oracle, though it is up today, it has become a poster child, just considering that the amount of spending has leapfrogged the others in terms of growth of it. 11-fold is how much Oracle is now spending on CapEx. That means that while the other companies, the other hyperscalers, Meta, Alphabet, that they are producing cash, that Oracle has converted into an outright cash burn. Can you still buy companies like that? And as the others start to feel pressure on their cash flow, can you still buy into these companies, even though there is a big promise of AI into the future?
It's a good question because cash flow is almost, the number one factor that we're looking at when we're looking at companies to add to our portfolios. I mean, we have a model with like 55 factors, but cash flow is so important to us. And so when we're looking and we see you get negative cash flow, and what is my return on that? I'm not really seeing a strong return. If you give me a great return on investment, then I feel more comfortable. But if I'm not seeing it yet and you're just promising me something, then I have to be a little more cautious, and I'm not as confident having a name like that in my portfolio. You look at some of the other hyperscalers, those balance sheets still look very strong. Cash flow may not be growing to the extent that it was before because of the spending that they're doing, but there's still strong numbers that you have there, so there's less concern. It is the size that you're seeing out of Oracle and what that's done to its balance sheet that is causing it to be different than the rest.
Hey, Victoria, just because you're in Texas and I believe born and raised in Houston, I got to ask about oil. I'm looking at maps go on the Bloomberg terminal and all the tankers floating around the earth, and there are a lot. It seems we're awash in Texas tea. So are we going to see prices continue to decline from here because Brent now is under 60?
Yeah, I think you look at that 55 to 60 level, and you could be in a range, in between there for quite an extended period of time because of the supply that we have. There is a glut of supply right now globally. The question is, can we see demand start to pick up, which then starts to eat away at some of that supply? The SPR, there's possibly some demand coming from there, but really we've lost a lot of demand out of China, and that's where we need to see things pick up. And as you guys spoke earlier in regards to Nike, the China consumer is not out there spending. That economy is weakening a little bit. So we need to see that demand pick up, and we just haven't seen it yet. And yet we're continuing to have supply out there. So we'll be watching OPEC, OPEC Plus, seeing what supply looks like going forward and hoping demand picks up as well.
Victoria, I have to ask, are you in the Crossmark office or is that your own home? Because that is a perfect Christmas tree, may I just say.
I am in the Crossmark office, so you can thank our employees for decorating that tree.
Well done to the team at Crossmark. Victoria, I hope you have a wonderful holiday season and a new year. That's Crossmark's Victoria Fernandez. Let's get a check on your stock market right now with the hopes of a Santa rally. We are up 0.5%. By the way, the bullishness in this market, it is off the charts. Bank of America pointing out that the flow into U.S. equities over the past week is the second biggest on record. So we're down so far in the month, but maybe we turn things around. Nvidia doing a lot of work to help us out again in that kind of scale to like we're so on versus the world is ending. We're on the so on portion with Nvidia up 2.3%, Broadcom, Oracle, Micron, again all the AI names rallying. What's moving us the lowest is Nike this morning after those earnings. The concerns in China, Meta also not having a great day, nor is Home Depot. Those shares down 1.4%. Here are your sectors this morning. Infotech does the best. Again, it's those AI players that's really helping us, and just because of the size and concentration in that. The overall index is up 0.5%. Consumer staples, utilities, discretion, again, those consumer names at the bottom hurt by Nike earnings alongside FedEx, Matt.
All right. Interesting look at the end of the week after the volatility that we've come through. Coming up, data center stocks are staging a rebound after the sector sold off on financing concerns in the AI supply chain. We'll dig deeper into this story that we cover every single day. This is Bloomberg Open Interest.
Let's get you some top calls. The analyst action that we're focusing on this morning. First up, Wedbush has downgraded Lyft to underperform. The analysts there point to concerns about the impact of autonomous vehicle disruption. Shares down 4.5%. Next up, Truist raises its price target on Nvidia to $275. They see more upside for AI capital expenditures in 2026. And as we'll talk about in a moment, all of these AI names doing really well today. That includes Coreweave. Citi has resumed their coverage of the company with a buy rating, highlighting a robust demand outlook for the company. Shares up almost 11%, Matt.
All right, so it's an up day for AI data center builders. Data center stocks in general climbing this morning as risk sentiment improves. Let's bring in Bloomberg Intelligence senior analyst Anurag Rana. And Anurag, as Danny points out, the news of the day moves these stocks a substantial amount, 10% gains and drops. Is the outlook that uncertain?
No, the outlook is that uncertain. These are highly beta names, and you should expect the same volatility next year for the entire group, frankly, because you'll hear one news of a data center delay, a lack of power, or some grid lockup, and all of these things would go downwards. But then the next day, you could see that, okay, they have signed a deal with somebody, and it's going to go the exactly opposite way. So this is a group with high beta and extreme volatility.
Anurag, as Matt mentioned, we're going to be talking to Sixth Street in just about under an hour's time. They've done some data center deals before. When it comes to private credit and their involvement in data centers, the big news of this week was Blue Owl and Oracle and the breakdown of a deal there. Are we sensing a shift in the willingness of private credit markets to fund the data center build out?
I really think depends on who the end client is. Daniel, there's the biggest question is whether the end client is somebody who has good funding and credibility, or I should say more, not just credibility, I would say visibility. Because, if Microsoft goes and signs a deal with Nebius to give them, let's say, $17 billion, I don't think anybody in the private credit would have any issue with that because I think Microsoft is good for that money and good for those workloads. And even if, let's say we go into a massive slowdown next year and, AI workloads, there's an issue, Microsoft can still use that funding for their own work, for the kind of their legacy business. So it's not an issue. But if you go for a brand new, let's say, a LLM provider, which we don't know how things will shape up over the next 3 to 5 years, that actually has a different impact. So I think it depends on who the end customer that's funding the expansion is.
I look at the growth of OpenAI, and even though we talk about it every day, the growth in terms of users always surprises me to the upside. It's incredible. And I wonder if you're seeing these same kinds of numbers at Gemini or at Anthropic. I mean, are people just adopting this technology at an incredibly rapid pace?
Absolutely. In fact, one of the surveys we did recently, OpenAI ranks as the top model of choice for 9 different industries. After that, it was Gemini, and then after that, it was Anthropic. But one of the good things we saw was when it comes to the software sector, Gemini and Anthropic are very close. We think Anthropic's enterprise presence is going to be a big factor both next year and the year after.
Hey, Anurag, just thinking about next year, too, one thing that's really been on my mind is so many guests come onto this show and they say something along the lines of the AI trade is going to broaden out. We're thinking about all these winners. People never talk about the losers, about business models that might be disrupted, about software companies that maybe become irrelevant. How are you thinking about that for 2026, and what type of companies maybe won't benefit, but on the other hand, will feel some serious pressure from AI?
Yeah, I mean, you can honestly go back the last 2 years and see the entire application software space. It's been crushed. I mean, it's not seen anywhere the same level of love it used 2 years ago. But at the same time, their revenue growth rate has been good. We have talked about Adobe, for example, for so long. They've done very well in terms of the KPIs and the different metrics. But year to date, it's down, I think, 20%. But if you go back and even history, it's well below its historical highs. You could extend that discussion to lately, there is all this headache about ServiceNow. So you pick any of the application software company, and there is some, you could say negative news about it in terms of that getting disrupted because of the LLMs that we just discussed.
Hey, I've been playing around with MapGo today. It's a great function on the Bloomberg terminal, but you can, with this tool, visualize all of the data centers. Well, this is global, but you can even zoom in and look at the U.S., and there's so many different flavors: retail, wholesale, public cloud, telco, financials, build-to-suit, crypto, etc. This looks already getting crowded in the Northeast, but is this going to just be completely full in 5 years?
Yeah, I think that the localization is going to be very important because, we have had some good conversations with DI's energy team, and I was led to believe that, when you look at the entire landscape, residential areas where there is a power shortage, it's going to be very hard to add new data centers. But the Midwest, where there could be some excess supply of power for people, there could be an expansion over there. So it's a question of where to place these data centers. And the other part is whether it's for training or for inference. If you need it for inference, you need it to be where the users are or close by it, unless we see some tech developments that can help us with that. So we do anticipate a much bigger footprint of data centers in the coming years.
And a lot of that is happening in my home state of Virginia, where I know Joe was so wisely zooming in on the map there. Anurag, we're going to have to end it there. Thank you so much. Bloomberg Intelligence's Anurag Rana. Coming up, SpaceX launching an obscure ETF into the spotlight. We're going to take a look into the ER shares private-public crossover ETF. That is a mouthful. We'll break it down for you next. You're watching Bloomberg Open Interest.
Vehicle pitching downrange.
Getting good call outs. Healthy system on the booster as it starts to catch over the Gulf.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks. Just about 22 minutes into the session right now. And we're seeing increasing gains. I mean, futures at the top of the hour were up only 1/10%. The cash trade were up 7/10, back to 68.23. The closing high from last week was 69.01. So we're clawing our way back there. The NASDAQ up more than 1% as the AI data center trade, as well as the TikTok celebrations are on. Nvidia up 3%. Obviously a huge part of the moves on any index it's listed. Oracle gaining more than 7%, also a boon to the S&P 500 and the NASDAQ. Nike is getting decimated this morning, showing investors that they really are having a tough time with the turnaround, having a tough time in China, having a tough time with the Converse brand. And FedEx also down on earnings, 1.5%. KB Home, a similar story, an earnings story, down 7.33%. We've been talking a lot on this program about the woes of the housing market. The hope is that more rate cuts are going to solve that issue. And then Coinbase Global right now up 1.5% because Bitcoin is gaining today 2.7% to $87,892. Danny?
Because at least for today, we are so back. By the way, as investors are gearing up for a potential SpaceX IPO, it is pushing an obscure ETF into the spotlight. The ER shares private-public crossover ETF has taken in more than $470 million this month. The fund holds a small, very small piece of SpaceX through a special purpose vehicle, potentially making it the only U.S.-listed ETF with exposure. Joining us now is Emily Grafeo, ETF and cross-asset reporter for Bloomberg News. Emily, what is this thing?
Okay, so this is an ETF that's been around since 2017. It was pretty small in terms of its asset size. Over the last several weeks, now that we've gotten this news that SpaceX is potentially going to IPO, potentially soon, it has ballooned in size. It's now over $1 billion in AUM. It just got its biggest daily inflow just yesterday, $258 million into the fund. Investors are buying it because when it first bought this SpaceX exposure a couple months ago, it was a 12% exposure. So you could get a pretty decent price exposure to SpaceX. And it was novel because typically we don't see ETFs holding shares in private companies. Now that the fund has ballooned so much in size, the ETF really holds only about 3% of SpaceX exposure. So it's showing us the limits here of putting private shares into an ETF, which trades every single day.
Yeah, it is, I think, absolutely fascinating. I'm looking at the holdings on the description page, and it's SPV exposure to SpaceX, SPV exposure to Klarna. So these are the special purpose vehicles that we talk about with the hyperscalers borrowing money to build out data centers. There are also a ton of publicly traded companies in this ETF. So it seems to have a particular focus on obviously tech. It's got Tesla, it's got Oracle, and Rocket Labs.
Yeah, if you look at the top holdings, they are public companies. So the idea here, it's this ETF, the ticker's XOVR, it's definitely becoming known as the SpaceX ETF.
Nvidia is the biggest holding,
but
right?
But Nvidia is the biggest holding. It is a tech focus. This company that issues the ETF, ER shares, they focus on companies that are led by entrepreneurs. So that is the push here. But again, it's really demonstrating that this push to put private illiquid assets into an ETF isn't as simple as you might think.
All right, Emily Grafeo, thank you very much for that. By the way, Emily is going to host this program on Wednesday next week.
For it.
And I'm looking forward. I'll be home and I'm going to tune in and watch it. This is Bloomberg. We are 30 minutes into this trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. It's a positive start to today. Second day of a rally. Will it hold as big tech leads to the way with Coreweave, Oracle, all of the big data center companies having a banner of a day?
We are also just about to get some economic data from the University of Michigan, and it is populating the eco screen right now, looking at sentiment at 52.9. That's a little less than the 53.5 the survey showed, and a little bit less than the 53.3 we saw in the prior readings. Also, existing home sales coming in at a gain of 0.5%. That's a little weaker than the 1.2% in the survey and the 1.2% that we had in the previous reading. And fortunately, I don't have to break this data down for you because Michael McKee is with us on set, our international economics and policy correspondent. And Mike, I just saw a stream of numbers come out on UMICH. There's so many different levels. What do you think is most important?
You break it, I fix it.
Okay.
I think at this point what we're looking for both is the headline number in terms of how are people feeling about the economy, but it's the inflation numbers that get people's attention. The University of Michigan's one-year inflation expectations number rises to 4.2% from 4.1%. That's not the right direction that the Fed wants to see things going, and certainly it wouldn't make people happy at 1600 Pennsylvania Avenue. 5 to 10-year inflation stays the same, 3.2%. Michigan current conditions falls a little bit, 50.4 from 50.7, and expectations fall to 54.6 from 55. Not big changes, but these numbers are pretty low. So it does continue the idea that even if certain people think the economy is A+++, most of the American consumers out there don't seem to think so. The big question with housing has been if rates go down, and mortgage rates have gone down some, would that help a lot? It has helped a little bit in that even though the gain was not as much as expected, as Matt noted, the total number of home sales on an annual basis of 4.13 million is up about 300,000 from where we saw it a prior month. So a little bit of good news in housing, but still not going to get you there in terms of fixing the economy.
Highest in 9 months. So that's the good part of the existing home sales number. Mike, thank you very much. Michael McKee, our international economics and policy correspondent. Sticking with the economy, we caught up yesterday with Jay Hatfield of Infrastructure Capital Management and got his outlook for Fed rate cuts.
And this is really the heart of our bull case. Inflation, CPI-U asymptotes to R, CPI-R. Inflation goes below 2. Fed cuts 3 times, not 2 times next year. Supports a 23 multiple, 8,000 targets.
Let's continue this conversation with Sarah Hunt, Alpine Saxon Wood's chief market strategist. And Sarah, the reason I pulled that piece of sound from yesterday is that I noticed you also think that even though the Fed is maybe talking a neutral game, they may cut more than expected because it looks like, at least from yesterday's data, inflation is getting a little bit better.
I think that I agree with that. I think that if that continues on the inflation side, I think the tricky thing with the inflation number is that it looks like there was some data that didn't quite get gathered properly. There's some questions about that. I think that we're going to have to be, because of the government shutdown, watching the data as it comes out, as you have more and more weeks where people have been working behind you. And I think that we all, we're such immediate people on Wall Street. We're like, well, you're back to work. Where are all the numbers? They should all come back immediately, right? So I think that it's going to depend on how those parse out over the next month or so, and the Fed's going to have more time to look at that data. But definitely, given the higher labor market issues and the lower inflation numbers, if those were true facts, I would say that is more supportive of Fed cuts.
We're so into immediacy and working that we are going to be working the 24th and 26th, even if President Trump says they're national holidays. How does this set us up for 2026? Because there are so many bullish sell-side calls. Jay Hatfield talking about 8,000. You also have John Stolfus targeting 8,000 too. Are you up there in that stratosphere that we could get to those types of levels end of 2026?
Funnily enough, when I was talking to my colleagues yesterday, one of the things that concerns me is how many strategists are putting out higher targets, because you don't want a trade to be looking like it's one direction. And generally speaking, the market likes to hurt the most people at the most time, right? So I don't know. I think you're going to see more volatility. It's really going to depend a lot on a number of factors. The data, for one, inflation. If that was wrong and it's stickier, that's going to be a problem. If the earnings can come through and there's some big expected earnings growth into next year, I think that that's very supportive. If you get any questions on the earnings growth number, I think that that is going to have some cause for volatility. And it wouldn't surprise me if we wake up on January, in the beginning of January, and people sort of reassess what the risk outlook is, given the fact that we're going into year end at very lofty levels on the indices relative to everything else. But there's been a lot of movement underneath those headline indexes, so I think that there's also room for some of the other stuff that we're waiting to catch up to do some work next year.
I mean, it's not the interesting thing or confounding thing is that it's not binary, right? They're all going to put out good earnings, Broadcom, Oracle, Microsoft, but they have to meet really lofty expectations because of the valuations.
Well, and it's not just putting out good earnings, right? Because Broadcom put out very good numbers. The problem was that the mix was a little bit to the lower margin AI as opposed to the high. So I think it's not just about give me absolute good numbers. Give me absolute good numbers, and I want the things that are the most expensive and the highest margin to do the best into next year from the investor standpoint. So even if you have good numbers, you can see some issues. I do think that you're going to see earnings growth, and there's going to be a lot of flipping back and forth between the narrative about AI as we've seen all year this year.
One of the things that I did not realize had been underway is that small caps, the Russell 2000, has rallied for 8 consecutive months. That is the best winning streak since 2021. There's been a lot of back and forth, a lot of false dawns with small caps. How are you thinking about them for next year?
This also plays right into if we have reasonably good economic numbers in the U.S. particularly, because the small caps are more domestically focused, and you do get a couple of other rate cuts, and or you don't look, people aren't as concerned about inflation. I think people have been looking for a small cap earnings boom for the last couple of years. And to your point, the fact that it's rallied for the last 8 months, I think people are beginning to believe it will happen in 2026. And if it does, I think that you can see you've had some underperformance for like 4 years or something now. So I think that there's reason to believe that that trade can continue to go as long as the underlying fundamentals look pretty good.
I'm looking at yields, and Ed Harrison for our Macro View wrote a column about how he thinks global yields are going to drag the U.S. 10-year higher. And it's interesting that the 10-year is still so much higher than it was when the Fed started its rate cutting cycle. But it looks like we could be easing down a little bit right now. What's your take on yields, and how important is it out 10 years to 30?
I think it's important because it's certainly important for the housing market. And I think that, people were looking for a little bit of a steepen around that yield curve at one point anyway. So what's tricky about that is that are they going up for the right reasons or for the wrong reasons? Are they going higher because people think the growth is going to be better? Are they going higher because people are worried that they need to get rewarded for the risk that they're taking? And what's happening on the global stage matters a lot to U.S. interest rates as well. But I think from a domestic standpoint, a lower 10-year, which has got a lot of mortgage-based things on it, is probably better because we're looking to get that housing market to do a little bit better. And even though it's 9 months, the best in 9 months, it's been really sclerotic because there hasn't been a lot of movement in the housing market for a variety of reasons that everybody's talked about, right? People don't want to move because they have low mortgages and everything else. But I do think you want to get that housing market moving.
Well, to the point of global yields, and maybe that's why we've in part seen the moves this morning, a BOJ hikes, an ECB, according to sources, saying that they might be done with their cutting cycle, a BOE, where that was a real debate too, and the call to cut was at a nice edge. That has been lifting global bond markets. How much is that going to be a problem for the U.S., not just the Fed, but a White House that also wants lower yields? How much will the global bond market be a thorn in its side?
I think it really depends on how that develops, because we were sort of, if you want to call it, late out of the gate compared to other central banks in cutting rates. So it may be that our cycle goes on a little bit longer, but there is that tension between how much disparity you can get between rates globally. And I think that, we're still dealing with the aftermath of the financial crisis, having zero interest rates for a really long time, and how those all interact. All of those relationships that you used to be able to say, I know what's going to happen when this happens, have sort of frayed. And so you don't really know how they play together post all that. And we're going to have to see how that plays out.
By the way, you can tell Danny has been filling in on surveillance this week.
You started with the bond
BOE,
question.
ECB, BOJ, and pretty soon she's going to talk about the Boston Red Sox and the Tottenham Hotspurs.
Oh my gosh. Honestly,
bifurcation.
Just fire me if we get to that point. I think that would be the end of me.
Sarah Hunt of Alpine, Saxon Woods, thank you so much for joining us. Have a fantastic holiday season, or whatever's most convenient.
You guys too. Yeah.
To you. Let's get a check on what's going on in the markets right now, because we do have a stronger cash trade than futures indicated. S&P 500 up 0.75% after finishing up that much just about yesterday at the close as well. So 68.25, getting back closer to an all-time high. The Nasdaq up more than 1% as it's a risk-on trade for the tech stocks today.
All right, coming up in the show, what a 2025 it has been from private credit, from going from a niche part of this market to ballooning to becoming the hot kid on Wall Street to talking about cracks and cockroaches. We're going to dive into all the themes and what 2026 will bring. We'll hear from Julian Salisbury, Sixth Street, a power player in private credit. That's coming up next. Stay with us for that conversation.
The most important thing is that you're making good loans and getting paid back.
No cockroaches.
So we want a very healthy ecosystem, and we have a very healthy ecosystem.
Termites are not eroding the foundation of private credit. I think that's the key.
Forget even cockroaches or otherwise, right? When you look at the fact, I think the point I'd like to make more is we're living truly in a K-shaped economy.
There's going to be good asset managers and bad asset managers.
Through history, the best managers are the ones that can discern between noise and fundamental.
Credit has grown tremendously, and our view is that it's going to continue to grow.
I think where dispersion in returns will happen is when you make more concentrated bets or you're reaching for incremental risk.
There will be winners, there will be losers, but ultimately nothing that rises to the level of systemic or really challenging the dominant narrative out there in markets.
Credit power player speaking with us here on Bloomberg Open Interest as we wrap up 2025. And I'm pleased to say to discuss the year that was and to look ahead of 2026 is Julian Salisbury, partner and co-CIO at Sixth Street. Julian, I'm so pleased that we're doing this with you because, first of all, I think you're one of the most clear voices in this industry. But also, I mean, what a crazy year it has been. How are you thinking about next year and just like the moment that private credit is in right now?
First of all, it's great to be here. Look, it's been a busy year. It's been an active year. The industry has grown tremendously fast. We just heard some of the actors in the space talking about the cracks and the issues. When an industry grows this fast, there are going to be bumps and scrapes. There are going to be increases in defaults naturally, and that's going to create headlines. But fundamentally, we think the credit market's going to set to grow. They're going to continue to create tremendous opportunities. But credit spreads are tight right now, so it's a time to be thoughtful, defensive, rather than lean in. What we've found is, given the flexibility of our capital, we don't have to chase and compress the yields in the plain vanilla segment of the market. It's been a segment of the market where we have felt skewing away to the more complex, artisanal, large-scale complex deals is where we've been able to generate returns, as opposed to just bidding down the plain vanilla leverage finance transactions.
Well, essentially because you think you have more talent, more experience, more expertise in these things. That's your edge, right?
I'd like to think so.
Yeah.
That's a presumptuous position, but I also think it's about how we design the business. We design the business and we created our funds and our liabilities that should enable us to be better investors. We do that because we care about performance. We think ultimately returns are going to matter. And if you raise vehicles that are always on, money's coming in, you have pressure to put money into the market, you have to lean in when the markets are hot, you have to lean away when there are dislocations, it's just a bad setup. We've been very intentional from day one to design our liability structures, our funds, that enable us to lean in moments of distress, step away, pivot, and find other things to do when we don't like the market conditions. And that's stood the test of time. It also means you're not crowded into trades that you don't like. So direct lending, large cap direct lending has been tight. Anybody who thinks otherwise, really isn't really talking plainly.
No, I'm sure it seems hyper competitive.
Yes.
And when we have the masters of the universe, of this credit universe, on the show, and we've had many, thanks to Danny, this year, they all want to say, look, we have an edge because of our expertise. And I just wonder how hot the talent war is in that case, because you must be competing for the best and brightest.
Look, what we found, it's been a tremendous market for us to hire talent because people like joining a platform where they're an investor. We're investors first. We're trying to generate great risk-adjusted returns. We don't have money piling up in a bank account that has to be put out the door the next day, and it's literally, what have you got for sale? I mean, that's how some participants are having to operate. It's just fact. Whereas, we've found that talent enjoys being part of an investor-first organization.
I mean, I was going to kind of go the opposite way of Matt and ask if it's less about talent and more about commoditization. I keep thinking, and I know I talked to you about this before, this FT story where they quoted an anonymous executive from Apollo who said, we're becoming a bank and it sucks because they're getting so big. There's so much money to be put to work. Can they put that money to work if you're that size and get alpha? Can the two exist together?
Look, it's a natural progression of markets. There's great analogs on the public market side. Today, people will manage core fixed income mandates for 1, 2, 3 basis points. Because it's become commoditized, it's easy to access, it's buying QSIPs on a screen. Those organizations at some point become, they determine that alpha is illusory and we should focus on service and price. And I think the more plain vanilla, more commoditized end of alternatives is naturally going to progress that way. So if you're a scale player doing the more plain vanilla stuff, and there are low barriers to entry, it's just going to get commoditized.
Is the industry being honest about that, though, or does that mean investors are bound for disappointment?
Look, I think it's a double-edged sword. On the one hand, notwithstanding the compression that's taken place, the returns are favorable versus public markets. So the fact that the market is growing in a greater array of retail investors are going to be able to have access to those returns is a good thing. But for the original institutional investors that back this space, they're going to see their returns compress on what they used to do, which means you have to evolve. And again, the way we set up our business model is we don't go and raise a fund that does one thing forever and ever and ever. We raise vehicles that allow us to pivot and change. So when we see the risk-adjusted return in a particular space erode, we can just pivot and do something else.
I want to ask specifically about AI data centers.
Yes.
It's such a hot space that our guests are all focused on. A lot of them have a huge piece of their book.
Yes.
Right? If I have my own private capital and I lend it to a hyperscaler to fund an AI data center, am I then just holding that and collecting returns, or am I hoping that the business is booming, it's more impressive than anyone expected, and I'm selling then those loans later for a higher price?
That's a very big question. I would say the short version is a lot of the lending that's going on right now in the data center space by the banks and the banks providing back leverage to other lenders in the space. These are amortizing loans that are really backed by the credit worthiness of the underlying credit tenant, and they're amortizing out over the life of the original lease. So they're not really having to take a data center bet per se. They're not taking a residual value bet per se. It's really a form of secured credit risk. That's the way they can look at it. Where it gets much more complicated is when you have to start taking views around what's the residual value at the end of that 15-year lease. Today, it's very clear. There are huge demand drivers that are going to push the demand for data centers over the next 3-5 years. There's also clear that the lack of power availability and the lack of equipment availabilities mean that the supply is going to be somewhat constrained. So that it feels to me that we're still in the early innings. It's not a bubble yet over the next few years, but at some point people are going to start questioning the residual value.
That feels frightening, though, that we kind of don't know where this is going. I mean, medium term, 5 years, great. But how does that change, or at least challenge, the investment thesis for some of these assets when there is this question mark further out?
Yeah. Look, I think this is the $64 million question. You've got to figure out, are these things going to have an obsolescence risk at the end of 15 years? Or is the fact that there is still power and there's a concrete shell? The actual equipment inside the data centers is getting continually switched out by the tenants. So that's one assumption you have to make. The second thing is, financeability. If you just add up all of the business plans of all of the data center developers that are out there right now and think about how much capital is going to be needed to debt finance all of these things, it's trillions of dollars, which is maybe absorbable in the grand scheme of an IG market, but it's a lot of money to absorb. So I think that it's this residual value bet and it's this financeability bet that are the two big things to understand and unpack.
Speaking of residual value, I think the assumption has been it's going to fall for a lot of companies in the software space. Because AI is not just threatening jobs, it's also threatening, business models. I think you were talking about this on surveillance this morning with Salesforce. And on the public market side, they've been punished. What's the picture look like in credit? Because credit lends a lot of money to software.
Absolutely.
businesses.
Historically, a lot of people have grown up over the last 15 years thinking lending to industrial companies and retail businesses is kind of dangerous commodities, God forbid. People lost their shirts in 2015. So people piled into software, TMT, and healthcare, and that's really been a core of most people's lending books, including ours, frankly. I think it's really important. You've got to start bifurcating when you look at these software businesses. There are some that have stickier customer relationships, they're more regulated in nature, the information is more sensitive, where those people are not quickly going to start handing over business to some AI startup. There are other types of businesses where those three factors don't exist that may be more exposed. And at least for that first category of software companies that I talk about, they're going to have the time to implement some of the AI capabilities themselves. And then it's just going to come down to who can make that shift.
Are you rethinking your exposure at all?
Look, it's a question that comes up with every software business we lend to, frankly, every business we lend to, but in the software space particularly, in the same way that we saw the traditional mainstream businesses get disrupted by the digital innovators. Are the digital innovators themselves now capable of disrupting themselves and being like the next winner, or is the next upstart going to take them up? And again, I think there are certain types of business models where they're going to have the time and they have enough of a moat around it that they have a better chance of winning in that space. Others are definitely going to lose.
Julian, I'm looking forward to many more conversations to come in 2026. Thank you for joining us. That's Julian Salisbury of 6th Street. Still ahead, we're going to talk Citadel and hedge funds returns. This is Bloomberg.
Let's get a check on the markets quickly here. Still looking at some decent gains on the S&P to end the week, up 0.6%. Not enough to bring us to gains for the week. I think we're still at a loss for the week, but 2 days in a row after a 4-day drop. Coming up, instead of earning coupons when you shop, you can earn stock in the actual company. We'll talk to John Garner, the founder of WeShop. One of the newest members of the NASDAQ is looking to turn shoppers into shareholders. WeShop rewards customers with points when they shop or refer friends, but instead of getting cash back or coupons, you can convert those points into shares of the company. And it listed directly on the NASDAQ last month. The stock's been going gangbusters ever since. Joining us now is John Garner, WeShop founder and head of vision and strategy. And, we just showed the chart, but you went from 20 to 200 right away. Yep. And what is it you think that investors are connecting to in the story?
I think one of the things, Matt, that we always believed in was if you can change consumers into owners, it's an amazing concept. America has a much deeper understanding of people with stockbroking accounts. So if you look at Robinhood, they've got 25 million users. You look at Schwab, they've got 37 million users. You look at Fidelity, they've got 45 million users. So we always believed, we did a pilot test in the United Kingdom. We put $140 million of sales through it, but the dream has always been to come to the US. It was a 2-year journey to get to the direct listing because no one's ever done this at this scale before. I'm glad we persevered with it. It was frustrating at times, but we absolutely persevered with it, and we got on there. And the valuation, obviously, it went through $5 billion at one point. And it allowed us to tell the story. And I think that story of ownership in a platform which you use has resonated as we hoped it would.
I think I've had a little bit of experience with this because when I lived in Berlin, I used to go to a bar called Brewdog all the time. And they would sell you equity, and in exchange, you'd get a discount on the beer, like 5% or 10% if you bought enough. But also, because you owned equity, you wanted to go to Brewdog over any other bar, right? Because then you have ownership, shared interest, right, in the success of the business.
Yeah, absolutely. And what we saw in our UK pilot is people are shopping from these retailers anyway. So it's the same retailers at the same price. We're giving you shares at zero investment cost. So imagine take the Brewdog example, which is a great brand. Imagine if every time you bought a pint of beer, they'd given you free shares, which you haven't had to pay for. Which bar are you going to?
I might develop a drinking problem.
That is very true. And maybe people will develop a shopping problem, which I think people do on their own without this. Anyway, John, you talked a little bit about the journey of becoming a public company. Just how complicated was it, given the very different structure that you had?
Yeah, so it was very complicated. We had amazing US counsel in Kirkland & Ellis, Christian Nagler, who led the transaction. There were a lot of technicalities. Everyone says, you know, it's an overnight success. Sometimes I say it's been a very long, dark night at times. But look, we got there, we persevered. The team at Kirkland were unbelievable. And we got there, and as you said, I say to people, we're on the dance floor now. So we've got the opportunity. It's really interesting that we weren't allowed to launch the app in the United States until we were listed, because we're deemed as selling securities where the consideration is pressing the button on the app. So I never thought it would be so hard to give something away for free. But we got there, we persevered with it, and I think you can see with what's happened with the share price that people are listening, which is great.
So you say you're partnering with businesses that people already want to go and buy stuff at. Anyway, I see Dick's Sporting Goods is one, GNC. We just showed Sam's Club there. Who are the most important partners for you, and who are you after? Who do you want to close now?
So everyone's important, of course. We've got over 500 of the amazing US retailers
Best Buy, Bloomingdale's, we have it here,
yeah,
Walmart.
Absolutely.
Yeah.
It's a constant process. I think some of those retailers saw what we've done in the UK, so they can see what the potential is in terms of driving sales. All partners are absolutely amazing. You know, we've got Walmart, Walgreens, CVS, like you say, Sam's Club. Also travel. So travel's really interesting. So everyone goes on holiday. We've got Expedia, we've got Booking.com. So you book your travel. And, you know, I use it all the time for travel because I'm traveling a lot. And I'm getting shares for doing that. So travel's actually really important to one. And what we saw in the UK was it makes the average order value actually quite high. So it was about £124 average order value because it's travel booking. So why wouldn't you use it?
One of the things you typically see with any publicly traded equity is that when there are more share issuances, when there's convertible bonds, there's a fear of dilution and shares tend to fall. How do you combat those fears?
So absolutely. So this is one of the big points that was brought to us when we first started coming to America. So what we did was we said to address that, we're going to issue all the shares and put it into a special purpose trust. So the trust is in Delaware, all the shares are outstanding. So there are no dilution issues there. The trust.
I see. So even as shoppers get equity for the spending that they do, it doesn't dilute the shareholders that currently.
So the trust will transfer the shares to you as the shoppers. All shares are outstanding. So we want transparency in the market. We want understanding the market. So absolutely, there is no dilution. All the shares are outstanding and sat in Delaware at the moment.
So when can we? I've downloaded the app and I was waiting to meet someone that I could refer.
You have now.
Yeah, so I wanted to give the gift of shares to someone. You already have enough shares. When I sign in, when can I start shopping at these brands? When does it
straight away
go live? It's live in New York, it's live in California, it's live across the US.
Absolutely. So we've got a waiting list there at the moment. We're letting people off slowly because we couldn't actually beta test it in the US until we were listed. So we are going at a steady pace. It's not just about the technology. The technology works. It's about building the community, which is really important. So we've got to build the community properly, and then it scales. But I will speak to the guys at Tech, and I'm sure we'll let you off.
There are some real concerns at this moment, John, about the state of the consumer, that people want value, that they're shopping at things that give them discounts, that Walmart, one of your partners, is doing really well. How are you thinking about the trajectory of the U.S. consumer? And if there is weakness presenting itself, how do you insulate yourself from that kind of risk?
So the consumers in America are amazing, obviously. People are looking for value, I get that. So if you use your a credit card, which you get points from as well, and you're shopping at WeShop, you're getting the points and you're getting the shares as well. So we are a zero cost value add to all the consumers wherever you shop. So you know that's what we want to do and give that ownership to the users and create that value. So we're not taking value away from anywhere. We're adding on top of what you're already doing.
John, it is fascinating. It is a really fascinating story. I'm glad you brought it to us. John Garner there of WeShop, now trading on the NASDAQ. Let's get a check on what's going on in markets this morning. We're looking at big gains on the NASDAQ, 1.2%, now 25,313. The S&P itself is up more than 0.8% at 6829, 6830. So after 4 days of losses, we had an up day yesterday, and it looks like we're going to put in some gains to close the week. Although you never know what happens between now and the close.
Yeah, it could be very different. For now, though, we are on track for weekly gains. Some of the single stocks that we're looking at this morning, Oracle, this is helping the NASDAQ a lot. They are rising. Shares are up 6.8%. All of these AI names, the data center builders, they are up today. Oracle maybe getting an extra boost. It is part of a group of buyers for U.S. TikTok who has said that they've signed the deal.
All right, Nike warned sales will decline this quarter amid weakness in China and with its Converse brand. And you can see Nike shares down 8.5%, so real punishing move there. The same true with FedEx, facing a string of cost headwinds, even as it raises the low end of its profit outlook. FedEx shares down only more than 1%, 1.2% there.
Coming up on the show, Ken Griffin's Citadel on track for its worst annual return since 2018. That's, of course, the hedge fund business. We're going to get the details next. This is Bloomberg.
There's two markets. There's the fixed income market, which is anxious about this journey, and there's the equity market. The equity market loves an easy money story. So what we're seeing is a tale of two very different worlds from the perspective of two very different investor groups, right? Your fixed income investor doesn't participate directly in the easy money policies. In fact, they're adverse to that. They're anxious about that. How much will inflation erode the value of the dollar that I lend to the government today? The equity market thrives on this.
Part of my interview this week with Citadel CEO Ken Griffin, and ironically, it was neither bonds nor equities that are producing an issue for Citadel. Bloomberg sources this morning telling us that the hedge fund is on track for its worst annual return since 2018 as natural gas profits have fallen. Joining us is the man behind that story, Nishant Kumar, Bloomberg chief hedge fund correspondent. Nishant, I think a lot of people, first off, would just be frankly surprised, again, the hedge fund team reporting this, that Citadel has such an outsized bet on natural gas.
Yes, I mean, if we look at their recent history, commodities trading has been a key differentiator for Citadel versus its rival multi-strategy hedge funds. While most large hedge funds rely primarily on, say, equities, rates, systematic trading, Citadel has built a far deeper commodities operation, including in natural gas. That helped, really supercharge its returns. Take, for example, 2022. It made $8 billion in commodities trading, which was half of its profit. The same was the case in the following 2 years, made $4 billion each in the 2 years, and again, half of its profits. Of course, it works really well when you are doing really great in commodities, but when it fails to fire, as it has been the case this year, the impact on performance is far more visible.
I should note, or I've been saying, I just think it's interesting that at the same time that Citadel, the hedge fund, is going to put up gains of less than 10%, Citadel Securities, right, the market-making firm, is crushing it. Right, it's up. Revenues are up 9-10% in the third quarter, and they're up, looking to have a record again this year. So the whole empire, the empire as a whole, I should say, is doing well. Which other hedge funds are having trouble or not keeping up with the benchmark?
I mean, Millennium is similarly positioned. So two of the biggest hedge funds are essentially hitting below their long-term averages. And look, Citadel is set for its 17th straight year of positive returns. So that's incredible in some way. And it's just 9.3% this year looks mediocre versus its own past. It's almost in line with average return of multi-strategy hedge funds. But if you look at Citadel, it has produced just under 20% annualized return over more than 3 decades. So that's why this 9.3% looks not so great for Citadel.
All right, Nishant, thanks so much for joining us. Bloomberg's Nishant Kumar talking about some of the hedge fund returns on the Bloomberg this morning. Now, a year ago, traders were piling into the so-called Trump trade, bets that his policies would pour fuel on the economy and stocks. Now the outlook is getting murkier for 2026, according to Bloomberg macro strategist Michael Ball. Michael joins us now at the desk, and we're talking about the Trump trade sort of energizing certain parts of the market, right? You're not saying that the market as a whole or that the S&P isn't going to have a great 2026, but what is it specifically that investors were betting on?
So people now are looking for two real pulses. One, that we're going to have this national security push continuing, which isn't new, and now more of a pivot to the affordability crisis, which showed up in the off-season elections and now have become a greater priority for policy. So this will be more sporadic, sector, single name, versus kind of this Trump trade that was good for business, that was going to bring everything rising as all tides lift all boats.
I say, because in some ways, instead of being looser regulation, it's been, I mean, we're still expected to get a lot of that in deregulation. It's been Trump's involvement in these markets, be it needing his blessing for various M&A, of wanting a bit of the action if Nvidia is going to be selling into China. How does that color where we go from here, and who are the winners and who are the losers?
Very apparent, even today, right? We have obviously the Oracle is getting a benefit here. From two things, from the Genesis project, which has helped the AI trade stabilize this week, as it's no longer looking like any kind of a bailout, but just a further injection and a further fiscal pulse through that channel. And then obviously, as we know, with the social media stuff with TikTok, and that was something Trump had to bless himself. So it's apparent always, and it's funny because you have to think about all of Trump's mind to really pick winners and losers in a certain sector.
There's a cool story on the Bloomberg this morning about John Paulson, and he has long been a gold bug. He's had obviously an incredible time with that because of the run up in that commodity. But often found with gold is a critical mineral called antimony. I believe it's antimony because it comes from the Latin antimonium. And it's called that because of the Greek anti and monos, not alone, right? It's a mineral that's often found with other minerals, for example, gold. This guy is going to get rich now on almost a gold byproduct as well as just the actual yellow metal he's mining for.
Yeah, and this is it. Like, again, we're getting so much critical resources, so much lithium, copper refining in China. It's all dependent on that. So as we want to have tech supremacy, we're still dependent on a supply chain that our adversary is basically holding. And this is why we're trying to push capital into any sources we can get this stuff and get off that supply chain that is dependent on China's cooperation. And as you guys know, this is still a turbulent relationship. There are pros and cons to everything, but there are certainly not a smooth path forward. And when we write about this in our 2026 outlook, we said this will be a big driver of overall market vol, how this relationship basically goes forward. And China still has a lot of leverage on that relationship.
But there's other things that are developing that kind of feel in the same vein. And I'm specifically thinking of Venezuela and the action that the U.S. is taking. In one hand, it feels counterintuitive because this is a White House that wants lower oil prices. So trying to issue a blockade in Venezuela when it comes to crude shipments coming out or tankers coming out seems counterintuitive. So what's kind of the push and pull between helping financial markets and securing natural resources for America?
Right, and then there's two ways to also look at this, right? Because it is about affordability. Trump doesn't want a spike. He's finally seeing those gas prices at levels that are really beneficial for the consumer. And two, he can't be rattling China, who's getting a lot of that Venezuelan oil, because we need them still for a lot of other stuff. So there is this balance that he can only push so far. And again, I don't want to use the taco trade thing because that's a little bit lazy, and I think it was overdone in 2025. But there are limitations to how far policy can push, and markets are going to smell that out, and they're going to get ahead of that and call kind of BS.
All right, great having you on the program. You hadn't heard of antimony before.
No, I like anti-money. I don't know. It's not right, but it sounds kind of like the opposite of what it is because it's making him a lot of money.
I'm a little bit obsessed with it because it's such a weird, I'd never heard of it before. Apparently it's number 51 on the
periodic table.
Yes, and but the ticker's SB.
Sure.
Because of stibnite, apparently. And there's a rumor that maybe, or there's a theory that maybe it's called antimony because of the Latin anti-monachos. Apparently in the 15th century, a monk saw that pigs eating it were getting fat, so he fed it to fellow monks, but because it's toxic to humans, they all died.
All right.
Anti-monk.
Wow, I never thought I would learn this on the show.
Let's hope Paulson doesn't eat any.
I didn't need to learn it either, but I'm happy I did.
It's so interesting. Michael, thank you so much for joining us. Michael Ball there of Bloomberg Markets Live. You can get his work by typing MLIV GO on the terminal. Coming up, the Trump administration pausing the U.S. green card lottery program. We'll head down to Washington next to tell you why. This is Bloomberg Open Interest. The Trump administration pausing the U.S. green card lottery program, saying that it was used by the suspect in the Brown University shooting and killing of an MIT professor. Homeland Security Secretary Kristi Noem writing in a post on X that the pause will, quote, ensure no more Americans are harmed by this disastrous program. And by that, she means that the green card lottery program has been disastrous. Bloomberg Washington correspondent Tyler Kendall joins us now. So, Tyler, what do we know about this pause? Is it permanent?
Hey, Matt. Well, at the moment, it is a pause. It's probably worth mentioning that if President Trump were to go further, that would very likely mean congressional approval. For example, he did unsuccessfully urge lawmakers back in 2017 to terminate the program altogether. So this really highlights how President Trump has been against this lottery program at this point for years, but does come against this broader, more recent backdrop that there has been this crackdown on immigration when it comes to the White House. Now, this diversity immigrant visa program annually awards about 50,000 visas, and it's actually designed to boost arrivals from countries with low rates of immigration to the United States. We're going to have to see how this ultimately evolves, because the administration really hasn't backed down from its immigration policies. In fact, in just this past year, as we look back at the first year of the Trump administration, there's been a whole slew of new policies announced, including a $100,000 fee for H-1B visas, the idea of vetting years of social media for those applying for tourist visas, and then also, importantly, expanding the travel and restriction ban to now 39 countries. Matt and Danny, I pulled some recent polling out this week from Pew, shows that 53% of Americans feel that President Trump's policies on immigration have gone too far. But of course, we know that this is an issue that polls really well when it comes to his base.
I was going to say just that, Tyler, because his base likes this. And this is also a president that it seems like has been in defense mode, trying to either justify his current policies or promising more policies to come. How much of what we're seeing for Trump, be it issues of affordability, being it trying to engineer more immigration crackdowns, is all with an eye to 2026 midterms?
Right, Danny. I mean, it feels like we are a long way from next November, but the campaigning is already starting. And we really saw that come to a head this week as the White House has been trying to change the narrative amid some pretty low polling numbers. For example, we had the head of Ipsos on Balance of Power earlier this week, who shows that President Trump's approval rating is now hovering around 39%. But importantly, he is seeing support erode among Republicans. That is why we saw this primetime address, President Trump trying to reassure Americans when it comes to his economic policies. But then also, as you're alluding to, we've seen a slew of new policies. Just look at the last 24 hours, right? President Trump announcing these checks going to U.S. service members, lobbing some domestic wins for the cannabis industry, for one example, also trying to rally support around the holidays by making the days around Christmas now federal holidays. So it is very clear that this administration is trying to change that narrative as we head into next year. Of course, Danny, looking ahead to tonight, President Trump is going to have his second installment on his domestic tour to talk about affordability. He's going to North Carolina. And to your questions about the midterms, he's going to the newly drawn 1st congressional district in North Carolina. That's now expected to go to Republicans.
All right, Tyler, thanks very much for that. And I wish you also a happy Hanukkah and or Merry Christmas. Bloomberg's Tyler Kendall there from Washington. I wanted to show a picture of our incredible team, because we wouldn't be able to do this without the hard work of everybody on that team. We went out and took a shot in front of the Bloomberg Christmas tree here. You can see
the one we chose.
And you can see Jen there. You can see Sandra, Sarah. Obviously, Danny right there in the middle with her giant head. Caitlin, there's Joe in the back corner, and the yellow shirt. You can see Will and Chastity as well. Missing are Terrell, who made my maps today, and Lee, our brilliant senior producer. We wish you all happy Hanukkah, a Merry Christmas, or whatever is most convenient.